Welcome back to Investing Talk Podcast.
Today we're looking at America's Car-Mart.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. What we're seeing here is a classic high-stakes turnaround story.
It really is. You're balancing these deep operational losses and, some lingering legal concerns against some very visible, very measurable improvements.
Exactly. And this is a perfect example of why you can't just look at the headline numbers.
Right. If you just look at Q2 of fiscal year 2026, the pain is obvious.
Oh, it's brutal. The company reported a net loss of, $22.48 million?
Yeah, which leads to a GAAP EPS of negative $2.71. That is a massive hit.
It is, but you have to understand that figure is the necessary cost of cleaning house. That loss is driven by two main things.
Okay.
First, you have the elevated credit losses from their older, much looser loan book. And second, the significant restructuring costs. We're talking store closures, layoffs, the works.
So these are headwinds they chose to face to fix the underlying business.
Precisely. What's so counterintuitive, though, is how the top line is holding up while all this is happening.
I was just about to bring that up. Management is actively tightening, underwriting, they're closing stores, actions that should crush sales.
And yet, Q2 revenue was $350.2 million.
Which is actually a slight increase, 0.8% year over year. It doesn't make sense at first glance.
That's the first big question you have to focus on. They're choosing quality over quantity, yet revenue is, stable. It speaks to the demand.
Right, the structural demand for what they offer.
Yeah.
And their pricing discipline.
And management has been clear about this. They said the unit volume softness, which was down about 5.7% in Q1, was not due to a lack of customers. It was inventory constraints and higher procurement costs. They're rebuilding inventory as their credit metrics normalize.
So they have the demand. They just need the balance sheet to handle the growth responsibly now.
And that sets the stage perfectly for the biggest bullish pillar here, which is the complete transformation of their financial foundation. For a lender like this, liquidity isn't just important.
It's everything. It is the lifeblood.
And their recent actions have completely de-risked their funding structure. The biggest move was back in October 2025.
The term loan.
The $300 million term loan. They immediately used it to pay off their entire revolving credit facility.
That one move gives them huge liquidity visibility. It removes a major near-term hurdle.
And the cash position that resulted from that is just a phenomenal safety cushion. Total cash jumped from, $124.5 million at the start of the year?
All the way up to $251 million. Think about that runway.
It's massive. That buffer lets management execute the rest of this complex turnaround without constantly scrambling for new financing.
And what's fascinating is how the capital markets have already started to notice.
Yes, they completed their 8th asset-backed securitization for $172 million, and they did it at a weighted average coupon of 5.46%.
Let's pause on that 5.46% figure because it is a huge leading indicator.
It really is. That interest rate, it's an 81 basis point improvement over a similar deal they did just a few months earlier in May.
So for anyone listening, a basis point is 0.01%. An 81 basis point improvement is almost a full percentage point reduction in their borrowing cost.
Which signals two things. First, the market sees their loan book as less risky. And second, that flows straight to the bottom line. It supports margin expansion for years to come.
And even while GAAP earnings are negative, there are other positive signs. Total collections grew 6.2% year over year in Q1.
And that's the engine. The collections growth supports their path back towards sustainable operating cash flow, especially as those older high-loss loans roll off.
Which brings us to the core thesis of this whole turnaround, the tech.
Right.
You've established the balance sheet is de-risked, the liquidity is there. But if the core product lending doesn't fundamentally change, none of it matters. So what's the actual fix happening under the hood?
The core fix is their new LOS V2 underwriting platform.
Loan origination system.
Exactly. And this isn't just, a software update. It's a complete replatforming, and it's powered by decades of their own proprietary data. It allows for this instantaneous, highly refined risk assessment.
And the results.
Yeah.
They're already tangible. This is the most compelling part of the bull case for me.
It's incredible. Management is reporting a measurable, significant difference. New loans under this LOS V2 system are showing an 18 to 20% better loss rate.
18 to 20%. That number is staggering for a lender in the subprime space. A 5% improvement would be good. 18% is a fundamental advantage.
It is the clearest, most direct path to margin repair over the next 12 to 24 months. As the bad debt gets replaced by this much better performing debt, their whole income statement flips.
It also shows they aren't just reacting to a bad credit environment, they've proactively built a system to avoid the riskiest borrowers.
That is the critical metric you need to focus on. The performance of the new product, not the hangover from the old.
And to make sure they have a safety net while this all happens, their provisioning for future losses looks incredibly conservative.
It is. Their allowance for credit losses is at 24.19% of average finance receivables.
So they've already set aside money for nearly a quarter of all the money that's owed to them.
Exactly. It provides massive future earnings leverage. Once those loss rates consistently fall, they can release some of those reserves back into earnings.
But it's not just about credit. They're attacking the cost side, too. Tell us about the operational efficiencies.
They're right-sizing the entire footprint. They're closing about 15 locations, which is roughly 10% of their store network. You couple that with necessary layoffs, and these measures are projected to deliver a huge $31.4 million in annual cost savings.
That $31.4 million is huge, and it's a guaranteed number, unlike credit losses, which depend on the economy.
Exactly. Once credit normalizes, that cost reduction alone will materially boost future earnings. It changes the whole profile of the company.
So let's shift to how the market has reacted. The price action has been sharp, which is typical for a company going through this kind of change.
The Q2 earnings triggered a classic expectation reset. The street was looking for positive adjusted EPS of about 0.29 cents.
And they delivered negative 0.79 cents.
Right. That caused a massive sell-off. The market is now completely focused on execution. They need to see the cost cuts, and they need to see that the new tech delivers those results consistently.
What's interesting from a technical view is the resilience we saw at the bottom. The stock traded near multi-year lows, but it bounced strongly in that low to mid $20 range.
Even after that bigger than expected loss, the shares didn't collapse further.
Which suggests that, professional value investors see that low to mid $20 range as a significant support zone.
And then you got the classic signal of insider conviction right after the miss.
The CFO purchase.
The CFO purchased shares at $25.27. When management puts their own money on the line right after a bad report, that's a powerful signal.
It's a strong belief that the stock is undervalued. But we can't ignore the other headwinds, specifically the legal and compliance issues.
That was a major cloud hanging over the company, for sure. You saw the class action investigation notices.
Yeah.
But the resolution here is key. Car-Mart has now filed its delayed 10K, so they are current on SEC reporting, and they've regained Nasdaq compliance.
And crucially, with no changes to previously reported operating results.
Exactly. That compliance cloud has been removed, which helps restore investor confidence.
Okay, but let's face the big risk here. The most obvious one is macro sensitivity. This company focuses on subprime customers.
That's the perpetual bear case, and it's a valid concern. The business is inherently sensitive to broad economic stress, inflation, a drop in used car values.
Right, which hurts their collateral. If the macro environment gets worse, those elevated credit losses could persist longer than the 12 to 24-month forecast.
But you could argue this risk is already baked into the price, right?
That's the counterpoint. The stock is trading like the worst-case scenario is already here.
And the proactive steps they've taken are a strong defense. The tighter underwriting, the proven 18-20% better performance, they're running a much tighter ship.
So if the economy stays tough, their new loan book is built to handle it better. And if it improves,
then they have positioned themselves for asymmetric upside as losses revert to historical norms. They're actively engineering their risk down.
So looking ahead, what's the next key catalyst we should be watching to confirm the story is really on track?
The next major checkpoint is the Q3 fiscal 2026 earnings release. That's likely coming in March 2026.
And that's the first major opportunity to see if they can confirm continued improvement in those loss rates.
And to provide concrete evidence that the cost savings are ramping up on schedule, we need to see that new credit book performing.
And this isn't a short-term trade. What's the investment horizon you need to have in mind here?
This is firmly a 12 to 36-month turnaround re-rating story. You need patience.
Patience for three things to align.
The old bad loans have to roll off the books. The new, better performing loans have to season and become the majority of the portfolio.
And the full run rate of that $31.4 million in cost savings has to be realized.
When those three things converge, the market will re-rate the stock.
So if we connect this to the bigger picture for you, you have a company that has significantly de-risked its balance sheet with a huge cash buffer and better funding. That's the foundation.
Right. And at the same time, it's proving out technology that drastically improves the performance of its core product. That's the future earnings engine. It's a very attractive setup for an inflection point.
That's exactly the takeaway. You have to look past the negative gap earnings of today and focus on those leading indicators.
The 18 to 20% better loss rates and the guaranteed $31.4 million in cost savings. That combination gives you a strong, measurable narrative for a recovery.
We'll definitely be following this one closely. Make sure you subscribe to Investing Talk podcast so you don't miss our next analysis.